Okay, so hello, hello, hello. Welcome everybody. Rocking and rolling in free world. Here we go, here we go. 11th of October, 2022. No trade calls, no recommendations. Everybody responds for their own stuff. We're here for educational purpose only. So as usual, committed to try and do these live streams every month, once a month, just shooting the breeze, looking at some charts, fairly interesting inflection points in the market across the board. Actually looks like equity is going to try and press some lows here. So happy to spend some time with you guys. If anybody has any comments, any questions, any chart, anything they want to look at, shoot in the comments. Usually the way this goes is my main focus is really just answering any questions anybody may have, reviewing any charts anybody may have. So as long as we've got questions and things to review, I'll keep on going. If nobody asks any questions, then I'll just talk a little bit about what I'm seeing in the market here, some key things, and then we'll wrap it up fairly quickly. So where are we? What's going on? Hey, Stefan in the house. Always the first question. How are you looking? Can you look at NVIDIA? Sure. Are we going to? Yeah, I will have to look. NVIDIA, that's funny because I was about to launch the live stream today and it didn't work because I had to upload my NVIDIA drivers. So I've been messing with that recently. So what's going on with NVIDIA? Well, basically here, we're in a situation where if you're looking at from monthly perspective, just looking back out. And again, we've talked about this a lot. This is just the air, really coming out a lot of these names. And basically, if you look at this, the first thing you'd want to do is basically to get a feel for where we are. If you look at off those lows into those highs, right? We've come back and basically we have essentially, moved back. Let me just clear this. Given back a huge part of this move, also linked to the froth in the crypto market. And here we're kind of hovering all the way through that 50 back retracement zone, hovering at the 50-week moving average and holding fairly heavy. Okay. So whether you're looking at this, and let me know if this answers your question in terms of the fibs or not, you see how the 78.6 retracement is also lining up with this previous high here, right? Which is around that 80 mark. So instinctively, that's a very, very interesting level. And you've got a couple of confluence points. So you've got that, actually, let me put it back up. And this is an interesting, so you've got that move off those lows. You've got three things lining up here, okay? So you have one, this previous high, which is also key here. Number two, this is the 78 retracement. And number three, you've got the 100-week moving average. Does that make sense? So you think it could go down to 75 by the end of, if I could recommend something very humbly, is it's okay to have price targets, but it's already hard enough to get the price right. I wouldn't put a timing on it, if you see what I mean, right? But basically, I think the focus is, you've got this clearly, that 75, 80 mark. That's clearly a key zone to look at. So what I would say is that unless we can recover last month's low, then here the risk is more of an unwind back into 80, right? You can look at that on the weekly. You see how it's lost the weekly moving average. And this is similar. You see this across a lot of charts. So basically, we came back into the 200-week, bam, the market tried, let me make this bigger. You see how the market tried to hold it 1, 2, 3 weeks, right, Stefan? And then once we broke below, the pressure is on, they're selling it. So this is really acting as a pivotal zone. Makes sense? So you can also look at it here if you prefer the weekly. As long as we hold below and any bounce into the 200 weeks gets hold, this likely means pressure on and we're going back into that 80, 75 zone. You can look at it on the daily. You can see that they're keeping the pressure on at the 10-day moving average. So it's the same chart across the board. Does that make sense? So here clearly very, very heavy flow, and even bounces can easily get sold to continue to move lower. Does that answer your question? So to me, the instead of guessing what could happen, the timing, is this Nortel and this 209, whatever, I just look at the chart very simply. And to me, what it says is, whether you're looking on a weekly or a monthly or on a daily, you see that the market has broken below, right, that essentially 120 mark. And since it's broken below this 120, as long as it holds below that, it's very, very heavy, and it's likely going to try and come back down into the 80. Okay, now what you're in a situation here, right, where it's not always like this. Hey Honor, hey Randy, I'll get to those questions in a second. Sometimes the markets are a little bit more complex. Here we're getting a situation where everything is really moving in sync. Right? Whether you're looking at a chart of gold, whether you're looking at a chart of the ES, NASDAQ, of the dollar, of bonds, everything is really moving in sync. So don't make it harder than it should be. Whether you want to be long short the dollar, long short Nvidia, long short stocks, long short bond, it's exactly the same trade here. And as we've been discussing, this is only trading on the Fed. As I've been trying to point out when we do these monthly updates, but we discuss this every day in the daily webinars and stuff, is the Fed has told us asset prices lower, rates higher. If you want to listen, good, you likely make money. If you don't want to listen, well, you likely had a very hard time trading here. And also the Fed has told it's all data dependent. So it's a binary outcome. Anytime the data is coming out strong, that means Fed, there's no reason for the Fed to change course. So you're going to see asset prices lower, rates higher. If the data starts to weaken, then there's a potential talk for a pause or some kind of a pivot for the Fed, or initially pause, and that would turn things around, right? So here, despite the fact that the market is very bearish, positioning is very bearish, and it's pretty much a one-sided trade, that's the move. So here it's going to be key, like tomorrow into the PPI, Thursday into the CPI. It's just like non-farm payrolls, right? Good data, bad for market. Bad data, good for market. Don't make it harder than it should be. Does that make sense, Stefan? So it's exactly the same chart. And you can see the same dynamics on most of the chart with the same levels, the same moving averages, yada, 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 yada. Okay? Now, yeah, and before I forget, and the market's being super technical, right? Even that Friday, yesterday, talk about a more textbook play. Data comes out in line, slightly better. What happens? Market's down. I posted it on Twitter. Tends to be a trend day lower. We get the trend day lower, gap down. It's very, very classical. Don't make it harder than it should be. It's a gift when the market is trading like this, right? So, second question on the list was on silver, right? So what's going on silver? Well, silver, we've discussed this for a long time, and let's get the silver chart up and look at the silver. Silver, you've got a lot of interesting things going on silver, and let me just clear this up and just get a blank chart just because it's funner that way, right? But essentially, there are a couple of key zones and key levels on silver. And one thing which is clear, right, is that if you are, no matter what you're focused on, what you're looking at, there are a couple of key zones on silver, okay? And this becomes really apparent if you're looking at it from a weekly perspective, okay? So basically on the weekly chart, you have this, let's call this $23.21 zone, okay? And basically, as you can see, is that this area kept on being defended every time we came back down. Strong support holding that area. And to the upside, you had another area which was essentially the 27, 30, okay? And basically, no matter what you wanted to do into those highs, basically, this was offered and they'd sell you as much as you wanted there, right? Capped. So it was stuck inside that trading range. Once we broke below, this becomes very, very heavy, okay? Surprise, surprise. Look at this. We talked about it all being the same chart across the board. You see how once we broke through the 200 week, that's what's being defended to the downside, right? So clearly that 21 zone, that's the pivotal level for silver, okay? That's really the pivotal level. And what you want to keep in mind is that from a monthly perspective, this is very, very choppy. You'd expect to see buyers trying to support any dip, but you don't really have, in my opinion, a clear zone, right? And the only thing that's the clearer is the upside resistance in this 21, 23 zone. To the downside, it's very, very messy. It's very, very messy. So my view on silver would be that as long as price can't recover back above the 21, especially on a weekly closing basis, this stays heavy. And the risk is for, you know, in a flush in risk and strong dollar kind of flush move that we take out these lows and we try and probe lower. And, you know, in a really ugly environment, we could even come and clip this. But on any closes below the above the 21 on the weekly perspective, then the risk is for a nice pop back into the 23. And above the 23, I think this becomes very constructive for a potential move back into the 27. Remember, silver is kind of like gold on crack. And you have a kind of this asymmetry in vol of silver versus gold, more to the downside than the upside. But that's what I would say. That's what I would say on silver. But again, everything is moving in sync. So right here, what you'll likely see is, you know, if that dollar gets really strong and you get a de-risking in general, markets are just going to puke everything and you'll see everything down with that dollar strengthening. And if we can have a little bit of a risk rally, maybe on some inline data, slightly weaker data, then you'd expect everything to rally a little bit as positioning is very skewed. But what I would focus on, because it's very choppy, something substantial has to change, I would prefer to look at the weekly closes, okay? I hope this answers your question on silver. Can you look at the Dow? Sure. Now, what's happening on the Dow? Well, basically, again, this is the same chart across the board, right? Whether you're looking at ES, NASDAQ, it's all the same, right? We're seeing you can see slightly different moves because of, you know, maybe some of the Dow components or the way banks behave, but essentially it's the same chart across the board. So I don't know if you have a specific question on the Dow, but I'll give you a kind of a more of a bigger picture view so far here. Our base case has been that, again, with this Fed asset prices lower, yada, 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 expect this to come back into the 50 back of the 2020 low, okay? And that would take us back into essentially 27,500, right? Something like that. And basically, surprise, surprise, weekly, same chart. You see what's happening even here. Once we break below the 200 week, the sellers are capping the makes sense, Randy? It's the same. They're capping the 200 week, and as long as we hold below, path of least resistance is more of an unwind lower. Okay, like silver, like everything else, if we get a weekly close above the 200 week, well, then likely we've got a potential to squeeze, and you could squeeze very aggressively and still hold bear market dynamics, right? Because here we could squeeze all the way back into 33,000, right? So just to give you an idea here, we could squeeze something like 13% on the Dow, and it still doesn't change the fact that if the Fed doesn't back off, if data starts getting hot again, this is still in a bigger move lower. Okay, so here we're also at an interesting zone. You've got a couple of interesting areas. You see this previous swing high that was defended, lines up with the 200-week and broke. So again, really, unless we can make our way back above here from a weekly close, chances are this still has more downside. Now, clearly, in terms of acceleration here from where we are now, 5%-ish lower, you'd expect to see a lot of bids coming in there. That's pretty much where the 200, that's pretty much here where these previous highs are. The 100 month is coming in at that 61.8. So the way I would look at it is on any move down, you would expect to see buying coming in at that 50 back. In a real worst case scenario, especially if you're looking to maybe try to average in or 401k money, I think that 61.8% is going to be an extremely interesting zone. That's just ahead of the 25,000 because that puts you in line with the 100-month moving average, but that's a very interesting zone. So I think those are the risks to the downside. And if you're looking at risks to the upside from here, what you would be looking at is on any pop, first of all, that whole 31,000 zone. But really, if you get maybe data really disappoints, this could easily pop all the way back into that 33 kind of zone. So those are the levels I would be looking at on the Dow. I don't know if that answers your question or you have anything else you want me to expand there on the Dow. But again, it's a very, very similar chart across the board, Randy, okay? Good stuff. So we've taken care of all the questions so far. So here, I think, again, you want to watch the bonds very closely today, right? And, everything's moving in sync. So you can see here on the dollar, right? This is the key, right? So dollar, as long as we trade above the 10-day here, the risk is for a little bit of a puke, right? In risk, unwind, and this dollar to try and shoot out and take out those highs. Because positioning is extremely stretched, remember, any kind of news that could get a little bit of a squeeze going, your base case assumption should be that, especially in stocks, a double-digit squeeze is just behind the corner, right? It's not your base case assumption, but if anything comes out, if data comes in a little bit weaker, then don't fight the squeeze. Let it come to you. Wait for much bigger levels on the squeeze. Look at those higher targets. There's really no point to step in front of it because we're overdue for some kind of a bounce. And chances are either we don't get any bounce, or if we get a bounce, it's a double-digit bounce. Okay, and that would mean markets puking to those new lows, dollar through those highs. We get that squeeze, then you would not be surprised to see the dollar coming back at the 109. Here, you can see the way basically the 10-year is trading is we're stuck here. It's a really hard trade to get long yields here because this is a key level. So here the risk is for a little bit of a move down. And what you want to look at today is see how these bonds, right, whether you're looking at ZN, ZBs, UBs, if these bonds can stabilize, then you would expect the dollar to try and catch a bid. So you'd expect Aussie, Kiwi, Euro, all to try and pop higher, that yen to try and come down a little bit, USD, CHF to try and come down a little bit, and that should try and help the equities pop a little bit. But really, it's the same trade across the board. So similar if you're looking at USD CAD, right? It's the same. Don't make it harder than it should be. This is a coil, right? This is a coil spring. In the same way that DXY, right, is a coil spring to rip through the 120s, right? It's the same thing on USD CAD. You see here, it's a coiled spring, but you have to respect the fact that, every time we've got into these highs, you've seen aggressive selling, defending. Does that make sense, Stefan? So the question is, what has to happen, right, to change the environment, or what has to come out to justify getting through all these offers and attracting new buyers at these highs and through those highs? Does that make sense? So something really extraordinary has to happen, because we haven't taken those highs out since 2014. So unless you're expecting a disaster scenario, short term, you'd expect it not to go knife through butter. If it goes through, you'd expect it to be more of a labored process. And because of the way we're set up here with everybody being max bearish, right? Everybody being looking for the world to end, it wouldn't be surprising to, whether you're looking at, for a little bit of a slowdown here. Also, October seasonals get a little bit better in the back end of the month, so that's something I would. But the point is, it's like I always say, Stefan, it's like those guys on Twitter or whatever. I'm going to be making friends now, but that go home every Friday expecting the next big Black Monday. Do you see what I mean? Always looking for the crash. Inevitably, crashes happen, but if you can't play for that to happen every day. Of course, there's some market cycles or some environments where it's more likely, but on balance, somebody who expects stocks to go up every single day versus somebody that expects them to go down, the guy who expects it to go up is going to have an easier life, right? Because 50, 52, 53% of the time stocks go up, and crashes just don't happen all the time, right? Yeah, okay, half of the big crashes in history happened in October. Some of the bigger moves happened in October. Okay, but let's put it this way. If you have, let's say, in 30 years of trading, right? You can't bet for a crash every October. Or you can bet for a crash every October, but net, the majority of the time, it ain't going to happen. Do you see what I mean? So what I'm saying is be open to whatever happens, but never expect something which by definition is an outlier move to expect an outlier move, that's all. So we'll have to see what happens. I mean, here, I'm not talking my book because I don't have any dollar exposure. Well, I don't have any open FX trades. I'm trading very tactically here. So I'm very open to anything, right? So this year is only the second. Yeah, but I mean, hey, since I don't know how long you've been looking at this stuff, but since 2002, every year, somebody's told us we're going to crash this year, right? So we'll see when we do, but you can't expect it. But here, I think the situation is we're in a market that is fairly easy to read with very, very binary outcomes on all these key data points. So my base case assumption would be, instead of betting for a pop to all-time highs, or instead of expecting the next big crash, is I'm going to trade tactically, right? And here's the ES chart, right? I'm going to trade tactically. And on the big data days like NFP, good data, I'm going to be short. I'll short the data point and I'll hold short until the end of the day for a trend day. PPI, CPI, good data, I'll get short, try and hold trend days short. Weaker data, I'll get long, trying to. And again, you're getting a situation where you're getting these fairly binary, fairly easy to read 50 to 100 handle moves on the ES. Why would I want to carry overnight risk when I've got that kind of action intraday? Do you see what I mean? So that's all. I don't know what people are doing. I think what, the main focus is focus on your account, what you're doing. That's what's going to pay the bills, right? But I think here it's clearly we're a market where you have to be open to anything. And clearly the setup is not pretty, and there is a big risk for a flush, right? But remember, the limit down overnight's what, 7%? You get a bad data point, this thing's going to be up double digits before anybody can blink. So you have to be careful. Also, here's the ES. If you're looking at it to the downside, right? You see, you've got a lot of structure to the downside, a lot of interesting supports into this 3,500. And, there'll be a lot of people trying to... So if this kind of double bottom action, okay, was happening at a confluence of a 200-week and here, say at the 34, I'd be a lot more worried about a potential for a drop and puke. Here, there are a lot of interesting points. There's a lot of interesting points, 3,500, 3,400. Also, all it takes is really, if the Fed wants to stem some bleeding, all they have to do is get on the headlines and say, well, we might have to pause. So, I don't know. I'm open to everybody, but I don't think we're necessarily here mortgage the house, mortgage the kids, and stay short. I think it's a market where you have to be a little bit more tactical. Clearly, as long as the Fed doesn't change, it's asset prices lower, yields higher, trading every sharp rally is a sell. But I think the market is readable enough, in sync, to trade it tactically without having to position trade aggressively, because we are in a situation where we're in a tactical market where it's not just a one-sided move. So I think, why make it harder than it should be, or why be stuck holding against these rips or dips, whichever side you want to be positioned, where you've got a lot of nice two-sided action. That's all. Any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? I think it's fairly clear. It's fairly binary. That's what I would be focused on. I wouldn't make it harder than it should be. Okay? Okay, so no more questions, no more charts. Okay, good stuff. Guys, thank you for spending some time with me. I'll post the recording, will be up on the blog and on... Hey, how's it going, man? Good stuff. So crude, what's going on? We looked at the dollar already. Crude, what's going on crude? I just focus on price action. Don't worry about what comes out of headlines in Ukraine. If you're worrying about any headlines, you want to be worried about the US data points. That's really the focus. Crude here, it's kind of like gold. We've got that kind of box lining up, right? So it's the same thing here. This is the key thing. And again, it's all the same trade. Risk down, people unwinding, dollar bid. Risk is for gold to puke and come back into, that 1550 zone. If we can stabilize, if the dollar comes off and risk and rally a little bit, you'd expect gold to get back into that box and try and make it back into the 1800. This is probably, as long as it doesn't go down too much, this is probably setting up some nicer seasonal plays for the back end of the year, but fairly similar action across the board. Crude, here's the box for crude. And as we discussed, the 95-100 is that key pivotal area. So right now, the fight is on between the defense, the shorts trying to defend the 95-100. You see how the selling's been coming in? And the longs needing to keep this inside the box, right? So here, what you want to watch is, how we trade here. You also have some confluence of the 50-day, the 10-day moving average coming in here. So what you want to watch this is from a day close perspective. As long as we can hold here, this is extremely key. Then the risk is that market will likely be continuing to try and smash into this 95-100 to get a day close, a weekly close above. That should open the big rip. But as long as this area continues to be defended and we trade below this box lows, then the risk is still that these stops are not safe and it's going to try and continue to flush lower back into the 60s. So what is my strategy to enter after a break of, so I don't really trade moving average breaks or stuff, right? So, but I mean, yeah, so you can use day closes. I mean, it depends. Everybody has different, I don't really trade those, but probably the best thing would be to trade day closes above or below. But here, everything is trading in sync. So that's what I would be looking at here in terms of crude. So HYG, I mean, this is just going to be trading in sync with all the bonds, right? So if you're looking at HYG, you're looking at TLT, you see what I mean? It's the same trade across the board. So as long as we're looking yields higher, asset prices lower, this is going to get smashed. If we get a little bit of relief, this is going to pop, right? So strong dollar, asset prices lower, yields higher, this is going to get smashed. Dollar comes off a little bit, yields will come down, stocks will go up, and bonds will catch a little bit of a bid, whether that's whether that's TLT, whether that's JNK, whether that's HYG. Again, as I said at the beginning of the session, it's the same trade across the board. Really don't make it harder than it should be, okay? Good stuff, guys. I'll post a recording. Thank you so much for spending some time with me. We'll do it again next month and talk to you guys soon. I'll post it on the blog. All the best. Take care, guys. Bye-bye.